If you're asking, how do I get a business loan? You're already ahead of a lot of people because most folks apply before they're actually ready. Getting a business loan is less about filling out an application and more about preparing a case. You're not just asking for money, you're asking a lender to believe you'll pay it back. So let's break this down step by step. First, lenders care about four main things: your credit, your cash flow, your collateral, and your clarity. Credit means both your personal credit score and, if established, your business credit profile. Cash flow means your ability to generate enough revenue to comfortably make loan payments. Collateral means assets that can secure the loan, like equipment, inventory, real estate, or in many cases, a personal guarantee. And clarity means you can clearly explain what the money is for and how it will increase revenue or stabilize the business. Now, let's talk about preparation. Before you walk into a bank or apply online, you should have three things ready. 1, a basic business plan that explains what you do, who you serve, how you make money, and what the loan will accomplish. 2, financial documents that usually includes at least 1 to 2 years of tax returns if you're established, recent profit and loss statements, and current bank statements. 3, a realistic projection of how the loan will impact revenue and your ability to repay. If you're brand new and don't have revenue yet, that doesn't mean you can't get financing, but traditional bank loans become harder. In that case, many people start with smaller options like microloans, community development lenders, credit unions, or SBA-backed loans. Speaking of SBA loans, let's clarify something. The Small Business Administration, or SBA, doesn't usually lend the money directly. Instead, they guarantee a portion of the loan through partner banks. That reduces the bank's risk and makes approval more likely for qualified borrowers. SBA loans often have lower interest rates and longer repayment terms, but they require solid documentation. There are also online lenders who move faster and require less paperwork, but the trade-off is usually higher interest rates. And then there are business lines of credit, which work more like a credit card. You borrow what you need, pay interest only on what you use, and reuse the line as you repay it. Now, here's the part most people don't want to hear. If your personal credit score is weak, your debt-to-income ratio is high, or your business is losing money, getting approved will be difficult. Lenders are not funding hope, they're funding probability. So before applying, it may make sense to strengthen your position. That could mean improving your credit score, paying down personal debt, increasing revenue consistency for several months, or building business credit in your company's name. And one more important point. Be very cautious about merchant cash advances or aggressive short-term financing offers. They can look easy, but the effective interest rates can be extremely high, and they can trap a struggling business in a cash flow spiral. In simple terms, getting a business loan comes down to this: prove that the money will generate more money and prove that you can handle repayment without gambling the entire operation. Preparation dramatically increases approval odds.